This is crazy. Bank of America has predicted 3 Fed rate hikes this year, going back on what they predicted earlier in the year, that the Fed will remain on a hold for the rest of the year. And the Treasury yields have ticked up in response with key data like July jobs ahead. Okay, so I gotta be honest. When I first saw this headline, I actually had to read it twice because, the whole conversation for months and months has been about rate cuts. When's the cut coming? How many cuts? And now suddenly we're talking about hikes, plural. 3 of them from one of the biggest banks on the planet. So let's actually get into this properly, because there's more going on underneath this than just one bank changing its mind. And I want to connect it to Stellar, to XLM, because honestly, the ISO 2022 side of this market does not exist in a vacuum. It exists inside whatever the macro environment happens to be doing. And right now, the macro environment is doing something pretty unusual. So the actual call, Bank of America's economist, a guy named Aditya Bade, he put out a note and basically said, look, we now expect the Fed to raise rates by 25 basis points in each of September, October, and December. This year, 3 hikes, quarter point each. That takes the policy rate up to somewhere between 4.25% and 4.5%. And here's the line that I think is actually the most important part of the whole note, more than the hikes themselves. He said, premature. That's a pretty direct way for a bank's chief economist to basically say, yeah, we were wrong, or at least the world moved in a different direction than we thought it would. And just to give you the full whiplash of this, because I think the whiplash is the story here, just a couple months ago, back in April, Bank of America was telling clients they still expected 2 rate cuts this year. Cuts, not hikes. They were holding firm on that even as other banks started backing off. Then in May, they shifted again, moved to okay. The Fed's going to stay on hold for the rest of 2026. No cuts, but also not really talking about hikes either. Just pause, wait, and see. And now, here we are, basically 1 month later, and it's not even on hold anymore. It's 3 actual rate increases. That's 3 different positions in 3 months. 3 from one of the most resourced research teams in the entire financial industry. And honestly, I don't say that as a knock on them. I say it because it tells you something about how fast the ground has been shifting underneath everyone's feet this year. So what actually happened to cause this? Because banks don't flip from cuts to hikes for no reason. There's got to be something concrete underneath it. The big piece, and I think most people watching this already kind of sense this, even if they haven't seen the specific numbers, is inflation, real inflation, not abstract inflation. Core PCE, that's the Fed's preferred measure. Personal consumption expenditures, stripping out food and energy. That number has been climbing. It was sitting around 3% back in December, and by April it had moved up to 3.3%. And Botha's own note flagged that May's reading could come in around 3.5%, getting close to a full percentage point above where it was just a few months prior. And remember, the Fed's actual target, the number they've been chasing this entire time, is 2%. So core inflation sitting at 3.5, heading the wrong direction, not the right direction. That's a real problem for anybody hoping for lower rates, and a huge chunk of why inflation moved that direction traces back to energy prices, which traces back to, honestly, geopolitics. The conflict that broke out involving Iran back at the end of February this year. Oil prices spiked hard after that, jumped from somewhere around $57 a barrel up toward a peak of $113 at one point in April before settling back down some. But even with it cooling off afterward, that spike worked its way through the whole economy. Transportation costs, manufacturing costs, basically everything that needs oil or gas to move or get meat. All of it got more expensive, and that shows up in the inflation data with a lag, which is part of why we're seeing it accelerate even now, months after the initial spike On top of the inflation piece, you've got a labor market that just refuses to cooperate with the idea that the economy needs help, needs lower rates to stay healthy. The jobs numbers have been coming in strong, like genuinely strong. 172,000 jobs added in May, 115,000 in April. The unemployment rate's been holding steady around 4.3%. And BOFA actually pointed to this directly in their note, saying the downside risks in the labor market have, quote, dissipated. Basically, the thing that would have justified cutting rates to support hiring, that justification just isn't there anymore because hiring's been fine, more than fine. And then there's the leadership change, which I think people underestimate the importance of. Jerome Powell's term wrapped up and Kevin Warsh stepped in as the new Fed chair, sworn in back in May. And here's the twist that I think a lot of people caught off guard. Warsh's appointment was originally read as a dovish pick, somebody who'd lean toward cutting rates, easing policy. That was the expectation going in. But his very first meeting as chair, June 17th, the Fed held rates steady, no surprise there. But the tone, the actual statement, the press conference, all of it came out hawkish, genuinely hawkish. He talked about being, quote, unanimous and unambiguous in fighting inflation, said the word price stability like a dozen times in that press conference alone. And the Fed's own internal projections, their DOPLOG, which is just each Fed official anonymously marking down where they think rates should be by year end. That dot plot shifted hard, too, back in March. It showed a median expectation of 3.4% by year end, basically pointing to one more cut. By June, that median had jumped to 3.8%, which actually points toward a hike, not a cut. 9 of the 18 officials who submitted projections see at least one hike this year. 6 of those 9 see at least two. So BOFA's 3-hike call isn't some lone outlier prediction floating out in space. It's actually pretty closely aligned with what the Fed's own people are now signaling internally. And that's really what moved Treasury yields, which is the part of this that ties back to, well, everything else in this market, including XLM. When the market reads a signal like that, hawkish chair, hawkish dot plot, hawkish bank forecasts, yields go up because bond prices and yields move in opposite directions. And if you think rates are staying higher for longer, you demand a higher yield to hold a bond instead of just sitting in cash that's earning more anyway. 2-year and 10-year Treasury yields have both moved noticeably since this whole pivot started happening. And specifically, right around the June Fed meeting itself, 2-year yields jumped 16 basis points in a single day. 10-year yields moved 6 basis points, and the stock market actually reacted too. S&P fell about 1.2%. Small caps, which are usually more sensitive to interest rates, fell even more, almost a full percent. Now, here's where the July jobs data piece comes in, and why everybody, and I mean everybody, trading anything right now has that date circled. The market is basically in this weird suspended state where the inflation story says hike, the job story says hike, but everybody also knows one bad print, one weak jobs number could completely flip that narrative. Again, the same way it's flipped, 3 or 4 times already this year. So the upcoming jobs report becomes this binary pressure point. If it comes in weak, suddenly the case for hikes gets shakier. Both as 3-hike call looks aggressive, yields might actually pull back. If it comes in strong, like May and April did, that just reinforces the whole hawkish narrative, makes September's hike basically a foregone conclusion in the market's eyes. So that's why this particular data release matters so much more than your average monthly jobs report usually does. Because right now, literally everything downstream of it, rate path, yields, dollar strength, All of it is sitting on a knife's edge, waiting to see which direction it tips. Okay, so now why does any of this actually matter for XLM, for Stellar, for the ISO 2022 side of things? Here's the honest structural answer, and I want to walk through this carefully because it's not as simple as rates up bad, rates down good, even though that is how a lot of people in the space tend to talk about it. Higher interest rates generally make risk assets less attractive on a relative basis because suddenly you can park your money in a Treasury bond and get 4.25% basically risk-free, guaranteed by the US government, instead of taking on the volatility of holding a crypto asset, hoping for a bigger return. That's just basic capital allocation. When the risk-free rate goes up, the bar that every other investment has to clear to be worth the risk goes up right alongside it. So in the short term, a genuinely hawkish surprise like this, 3 actual hikes instead of cuts, that's generally a headwind, not a tailwind for crypto. Broadly, XLM included. The market reaction we already saw, stocks down, yields up. That's the kind of environment where speculative and growth-oriented assets tend to get repriced lower, at least in the immediate aftermath. And this is the part I think actually matters more for something like Stellar specifically versus, say, a purely speculative token. Higher rates also change the calculus for stablecoins, and stablecoins are basically the engine running through the Stellar network. When interest rates rise, the yield that stablecoin issuers can earn on their reserves backing those stablecoins, the actual dollars and Treasury bills sitting behind every token in circulation, the yield goes up too. Circle's USDC, for example, generates revenue largely from interest on its reserve holdings. And those reserves are parked substantially in short-term treasuries. If short-term rates climb because the Fed actually hikes 3 times this year, the revenue stablecoin issuers earn on their reserves climbs right alongside it. That's actually a structural tailwind for the stablecoin business model itself, even while it's simultaneously a headwind for the token price of more speculative assets sitting in the same broader crypto market. And Stellar's entire pitch, the actual use case that DTCC and others have been building toward, isn't buy XLM and hope it goes up because rates are low and money is cheap. It's move stablecoins. Move tokenized real-world assets across this network fast and cheap. A higher rate environment doesn't really threaten that use case at all. If anything, a higher rate world makes the underlying dollar-denominated assets moving across these rails, the actual stablecoins themselves, more attractive to hold for the institutions issuing and managing those assets. Because there's real yield sitting behind every dollar afloat. So you've got this kind of split effect happening simultaneously. The token XLM itself probably faces some near-term pressure in a higher rate world because that's just how risk assets behave when the alternative cash and short treasuries suddenly pays more. But the actual infrastructure use case and the reason institutions are building on this network in the first place doesn't really care whether the Fed funds rate is 3.5% or 4.5%. The settlement still needs to happen, and the stablecoin still needs a rail to move on. That part of the thesis is basically rate agnostic. There's also a currency angle worth mentioning here, because higher US rates tend to strengthen the dollar. All else equal, since higher yields attract foreign capital into dollar-denominated assets. And a stronger dollar actually reinforces, in a kind of roundabout way, the demand for dollar-pegged stablecoins, specifically in places around the world where local currencies are weakening against the dollar. At the same time, that's been a documented pattern for years now. People in countries with unstable local currencies turning to dollar stablecoins as a way to preserve value, and a rate environment that strengthens the dollar further can actually accelerate that exact behavior, even while it's simultaneously creating headwinds for crypto risk assets more broadly. So it's genuinely a mixed picture, not a clean story in either direction. I also want to flag honestly how uncertain all of this still is, because I think it would be dishonest to present Buffett's 3 hike call as some kind of settled outcome. This is a forecast. It's an informed one. It lines up with the Fed's own recent signals, but it is still just one research team's read on a situation that has already changed direction multiple times in a matter of months. The Fed itself hasn't committed to 3 hikes. The DOT plot shows a split committee, with 8 officials still seeing no move at all, or even a cut, against the 9 leaning toward at least 1 hike. That's about as close to a coin flip internally as you're going to see. And remember, there's apparently a provisional peace arrangement involving Iran now, too. And if energy prices keep cooling from their April peak, a lot of the inflationary pressure that's driving this whole hawkish shift could ease up faster than people currently expect, which would put the cut conversation right back on the table just as quickly as it left it. So where does that leave things practically for anyone holding XLM and watching this macro picture unfold? The honest takeaway isn't sell now because rates are going up, and it isn't ignore this because Stellar's thesis is bulletproof either. It's that you're watching 2 different timelines play out on 2 different speeds. The macro rate environment moves on a calendar of Fed meetings, jobs reports, inflation prints, all of it choppy, all of it capable of reversing direction again, like it already has 3 or 4 times this year. The institutional adoption thesis behind Stellar, the actual DTCC integration, the actual stablecoin settlement volume that moves on a much slower, much steadier calendar measured in quarters and years, not in single data releases. Higher rates can absolutely create real near-term pressure on the price. They don't really touch the underlying reasons serious money has been building on this network in the first place. If walking through something this tangled, actually connecting the Fed, the bond market, and what it means for a network like Stellar, instead of just reacting to a scary headline about rate hikes, if that's useful to you, go ahead and hit like on this one. It genuinely helps put this kind of breakdown in front of more people trying to actually understand what's moving this market instead of just guessing. Subscribe if you want this kind of macro to crypto connection. Tracked closely, because between the jobs report coming up and whatever the Fed decides in September, there is a lot still left to play out here. Drop a comment and tell me, do you think Buffett's 3 hike call actually holds for the rest of the year? Or do you think this gets reversed again the same way their last 2 calls did? I'm genuinely curious how confident people are in a forecast that's already flipped this many times in a single year. And if you know somebody who panics every time they see a rate hike headline without actually understanding what it does and doesn't touch in this market, send them this one. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart, signing off.